Is Yeti a good investment? Let's put it to the test by putting it up into our checklists. I'm Brian Feroldi.
I am Brian Stoffel.
And I'm star guest, Austin Lieberman.
Well done, Austin Lieberman. Yes, today we have a special episode. We are welcomed by a longtime friend, Austin Lieberman, an emerging portfolio manager at Social Capital, and we're going to be discussing Yeti. Austin and I thought it would be fun if we all reviewed Yeti together. We put it through my framework, we put it through the anti-fragile framework, and then Austin also put it through my framework at the same time to see where our results differ. Investing is subjective, so it'll be interesting to see if we come up with different answers, and that wouldn't really surprise me that much. But with that, Brian, how do we start?
Well, hold on. I'm gonna interrupt real quick. I know I'm not really supposed to do this. This is your show, Brian. But before we start, I just want to say thank you to both of you, not only for being here and for what you do for the financial community, but you both personally spent time helping me. And this was 5 years ago now, when I first kind of started with the Motley Fool. You took time out of your day and away from your families to just spend a lot of time with me, helping me learn the whole writing side. And then from there, we've, just been friends since. And so I just want to thank you both for the time you put in to help me and so many other people. Thanks.
Appreciate that.
Well, thank you. And you're very welcome. It's easy to help people like you, Austin.
Totally. People that are passionate and really into helping others too. So thank you for that. All right. And I guess we should also say everything that we're about to say is our opinion. Don't take it as gospel. Social Capital, the Motley Fool, none of them are responsible for anything we just have to say about this company. We don't know and have not researched Yeti yet. So we're going to be learning right along you side. All good, Austin, there? All right. So let's start. So we're going to be going over to my checklist. We start by putting in the ticker symbol there, YETI. I assume this is a brand that you guys are familiar with. Like I have a Yeti mug here. Do you guys own any Yeti products?
My wife's is upstairs. My wife has one, but I don't. She got it as a gift. For me, they're just too expensive. But I'm a penny pincher.
Austin?
Yeah, so funny story is hurricane season. This is 2 years ago. We went and we couldn't find a cooler we needed. So we ended up going and buying a Yeti cooler that we thought was way too expensive. And they have a great return policy. So I used it for a few days and then don't judge me, but I did return it.
Not judging.
Because those things are so expensive. But it worked great, though. It kept stuff frozen and cold. So it was a great cooler.
My takeaway on this company before we get into the investment is it's essentially Lululemon for men, right? It's like a brand name that really appeals to guys that want rugged things that work and they're willing to pay a premium for it. So let's see if that translates into investing success. So we're going to be filling out the Feroldi quality score, the anti-fragile score, as well as all this other kind of stuff. So let's start here. We'll scroll over, type in a new ticker, Yeti. And I'm going to open up a new search, and we're going to go to Yeti Investor Relations. Pull it up, and here we go. Okay. Yeti is a rapidly growing designer, marketer, retailer. I didn't know they were a retailer, and distributor of a variety of innovative, branded, premium products to a wide-ranging customer base. That's a mouthful. Our brand promises to ensure each Yeti product delivers exceptional performance and durability in any environment, whether in the remote wilderness, at the beach, or anywhere else life takes you. By consistently delivering high-performance products, we have built a following of engaged brand loyalists throughout the United States, Canada, Australia, and elsewhere. I believe that, right? People that like Yeti, they're as passionate about Yeti as passionate as Lululemon fanatics are, right?
I mean, I'm going to claim ignorance right off the bat here because I thought it was just coolers and stuff. And I'm getting the feeling that it's much, much more than that. And I mean cup coolers.
Nope. I think they do more than that, but
I'm sure they do.
As in a presentation. Yeah. That's great. That always makes things easy.
When I think about coolers and really cups and stuff, there's the brand that comes to mind, and maybe it's because we're talking about Yeti, but there's only one brand that comes to that is even memorable or remarkable, and that's for me, it's definitely Yeti. Like out of, I couldn't even really, I guess Igloo, right, is kind of like
Coleman.
a generic cheap brand. All right, well, maybe there's more, but anyways, Yeti definitely comes to mind.
All right.
Coleman's like our grandparents.
Correct.
You're dating yourself there,
You
Brian.
probably have a Coleman product in your house. All right. So strategic priorities. Expand our customer base. Good priority. Fast Company named Yeti as one of the 10 most innovative branding companies of 2021. Okay. We're going to be doing more marketing. New support our new Crossroad bag collection. I don't know what that is. Introduce new products. So across coolers and equipment grew 57%. Drinkware grew 32%. Our Crossroad bags collection of backpacks, duffels, and luggage.
Really?
Yeah, I guess so.
Interesting.
New spring colors. Okay. Accelerate direct to consumer. Direct consumer grew 51%. 51% of channel mix. So half of sales are directly from consumers, not through retailers. Okay.
So I wonder how sustainable that's going to be, because so many retailers were shut down that I wonder if that 51% is going to stay that strong once all retailers are open, or maybe, who knows, maybe it's just growth opportunity there. But
sure, I mean, if you're already ordering from them online, and who knows is a question there. International expansion, so that grew 146% and is 9% of sales. So 91% of sales are in the United States. Local language e-commerce sites in Germany, France, Italy, and the Netherlands and Ireland. Europe, UK wholesales expansion to over 250 doors, double-digit locations in 10 countries. Okay. All right, so here we go. Here's mix. So drinks are 57%. Coolers and equipment are 41%. Look at all these products, Brian.
That's incredible. Can you zoom in just once on that?
Yeah.
So the equipment includes, is that a chair?
That's a chair.
With like a built-in cooler, I bet?
Duffel bag. I don't see I don't see that on there. I know them mostly for its drinks, right?
Yeah,
it's like coolers, that kind of stuff. Hats, bottle opener, ice coolers with a hole in the middle for some reason.
I had no idea that they made like bags.
All right, so this is as of last quarter. $1 billion in sales. That's more than I was.
Over the last 12 months.
Oh yeah, you're right. You're right. Thank you for that. Last 12 months, as of the first quarter. Thank you for that. 1.1 billion in sales, 25% growth.
Yeah.
30% growth in coolers, 20% in drinkware, 2% in wholesale, and 55% in DTC. So yeah, big time expansion in DTC at the expense of wholesale. Adjusted operating income of an adjusted operating margin of 21%. That's impressive.
That's that premium name brand.
Yes. Okay, so hunting, fishing, now we do that, plus beer and barbecue, wellness, sports, surf, paddle. Okay.
Music.
139 ambassadors. What does that mean? 13 communities?
I would guess that's people out there on social media, kind of advertising, for them.
Yeah.
Look at this. Look at this. There we go. Strong, diverse media reach. Yeti at 1.6 million. Instagram followers. So half of Lululemon. Wow, the North Face is leading there. I wouldn't have guessed that. Earned media awards. People love us. Yes, we're all over the news. Broadening awareness and demographics. Unaided brand awareness. So this is when you say, name a company that makes coolers, and people say Yeti without you prompting them. So 14% of people in the US, and much stronger in the West, North, Central. Okay.
It does say that this is per Yeti's brand tracking study. So it looks like maybe that's an internal study.
Yep. I mean, I would buy this though. I don't think I'd heard of Yeti 2 years ago.
If they've got those margins, I believe it.
Okay. Products and category evolution. So the duffel bags was launched in 2017. New products all the time. Innovation creates reasons to buy and increases the addressable market. Okay. Yep. Channel and supply chain highlights. 2015, they were 92% wholesale, and now they're 54%. Yeah. Obviously, a bunch of that is pandemic related, but it's curious to see what steady state looks like. Because the Yeti brand name is a heck of a lot stronger today than it was 6 years ago.
Yeah.
No account exceeds 10% of gross sales. So that answers that question about concentration. So they're available in all these brands. Direct to consumer, corporate sales, Amazon Marketplace. Okay. And so they entered Canada in 2017, England in 2017. All right. So they're mostly in English speaking countries, except for, is that Japan?
That's what it looks like.
Okay. Yeti.com. Corporate sales. Oh, that's a good idea. So that like corporations buy it and then they brand the Yeti with their name on it.
Huh.
Okay.
Yeah, I'm curious how that works, the whole corporate sales side. That's interesting.
I wonder how big of a deal that is with the total sales. But all right, so they're in these countries. They're just wholesale in Japan. Expansion, e-commerce, enter markets, push brand, visa, ambassadors, influencers, and event marketing. Considerable international opportunity. So Nike is 60% of sales. Yeti is, well, now they're 9%, remember? Global leading supply chain, third-party manufacturers and logistics. Yeah, where are these made? Did they say that? In the U.S. and
Dallas,
in Asia?
Salt Lake, Australia, New Zealand.
Well, that's a distribution.
Distribution,
yeah. Optimizing quality, delivery, and cost. Completed should cost analysis and supplier negotiations. I don't know what that means. Okay, but we're ramping that. Financials, here we go. Okay, sales grew 42%. Year over year.
Did you see that picture of remote working out there in the wilderness with your?
Oh, there you go.
With your Yeti. It's also a desk. Look at that.
Look at all the uses for that. You need a rock though, not provided.
Listen, if they get high quality Wi-Fi, we might start bringing this show to YouTube from the great outdoors.
Yeah. Sales up 42%. Coolers grew 50%. Drinks grew 32%. The channel, so everything was up. 42% is a pretty strong growth rate. Year over year. Okay. Gross profit, 58% gross profit margin.
Okay.
SG&A only grew 30%, 36%. That's a weird way to display that. So they got operating leverage because their SG&A went up at a slower pace than gross profit. Adjusted operating income margin. Yeah, look at that. They almost grew their operating margin by 70%.
Wow.
And adjusted earnings 233% to 38 cents per share. So they had a nice quarter. Net sales were up. Gross profit was up faster. Operating income was up. Adjusted net income per share was $1.87. So yeah, that was 80% growth in 2020. Not bad for a consumer brand. Although I think Lululemon had a good year.
Yeah,
right?
they did.
Yeah.
Some consumer brands did not suffer.
Right. Cash, $253 million. Free cash flow, $351 million. And they've been positive for at least 3 years. So
$251 million. That's a lot.
That is a lot. 250 fiscal year. Okay, fiscal year. So yeah, this should be as of March 31st, I'm hoping. So cash, $253 million. Total debt is $135, and that's down. So they have been paying off debt. And they now have $100 million in net cash plus almost $350 million of free cash flow. CapEx is only 2% of sales. So that's a really capital light business. Great.
Wow.
Very cool. Okay. That was a good earnings report. All right. What's next? Let's go to the annual report. So let's pull up the annual report 2020 and the proxy statement right next to it. Okay. So this is the annual report. Let's start reading through. Overview. Headquartered in Austin, Texas. I've never seen a report start like that before.
Interesting.
Yeti is a global designer, retailer, and distributor of a variety of innovative outdoor products. Are built to meet the unique needs and varying needs of diverse outdoor products. Yep, we read that already. We were founded in 2006 by avid outdoorsmen Roy and Ryan Siders, our founders, who were frustrated with the equipment that could not keep pace with their interest in hunting and fishing. By utilizing forward-thinking design and advanced manufacturing techniques, they developed a nearly indestructible hard cooler with superior ice retention. Anecdotally, I know that people that have these things say that they keep things cold as if they were a refrigerator.
Hey, Austin used it during a hurricane.
Yes. So, and clearly they have a generous return policy too. Our original hard cooler not only developed exceptional performance, it's anchored by authentic, passionate, and durable bond amongst consumers to our company. Okay. We IPO'd on the New York Stock Exchange in 2018. Okay. Coolers and equipment, drinkware, and other. We have a history of consistently broadening our high-performance, premium-priced product portfolio to meet the expanding needs of our customer base. Yep, so coolers and equipment. So they have hard coolers. They have hard coolers. They have soft coolers, storage bags, and outdoor living. They have drinkware and other stuff. Sales channels. So we know that they're primarily DTC now. Their wholesale channels goes to Dick's, Lowe's, REI, Academy Sports, Bass Pro, Ace Hardware, and Williams-Sonoma. Wow, I don't see Walmart on there. I don't see Target on there.
I'll just chime in for 1 second. That's great, in my opinion, if the brand is so important to them. I mean, we could get into it, but that's the mistake that Under Armour made when they decided to start giving to those people.
So you think
those retailers?
So I think the mistake that Under Armour made was that it discounted its products. Not that it sold them through Walmart. It's that they did so. It's that they really went and said, and they started offering it like TJ Maxx.
True.
So it trained buyers that you don't have to pay a premium to get Under Armour.
That's fair. That's fair.
So I was just
going to say, I think, we talked about Coleman, right? Is like, I don't know for sure. We had to look at this. We probably don't have the time in this show, but when I think about like REI and Bass Pro Shops, I don't know that Coleman sells there, but then, Yeti does. And it's like people, I feel like they could probably only need to sell so much and they can only distribute so much right now. So they're probably really focused on the more premium categories. And then Ace Hardware, I see their stuff at Ace all the time. That's
Ace Hardware. Yeah. That's a funny one.
You see Yeti at Ace or Coleman?
Yeti.
Oh, okay.
Yeah, that's another one. They're not at Home Depot. That seems like a 1-to-1 brand. Duluth Trading would be another one. So anyway,
you're saying you think that's an opportunity?
Yes. Okay. Definitely. I think that's an opportunity. If you saw a Yeti product at Walmart, would your mind go to, oh, Yeti's a terrible brand now? Or would you go to, yes, I can now buy this at a convenient location?
I don't know, but that's because the Walmart near where I live is not a fun experience. So I'm probably not a good, truth be told, I would say Yeti would step down. It's just very poorly run. And so I'm not a good proxy.
Austin, you're a better proxy then.
Yeah. I think they have this premium brand image that they want to keep. And they probably have a ton of data about their buyers because of their social media presence. And then they also want the experience of going and like feeling their products and buying them. They probably want that to be a high class experience in their opinion, which you get that at REI, you get that at Bass Pro Shops. And then it's also like the types of things that people are going to those stores to buy are exactly what Yeti falls into, where at Walmart and Target, it's just another brand. And the other thing is they probably have a lot less negotiating power with somebody like Walmart and Home Depot than some of these like smaller, more niche stores. So I think I'm on Brian S.'s side on this one.
Okay. Well, we'll see what happens, but they're taking that strategy for now. So they have 4,500 independent retail partners. They sell both directly and they While nobody accounts for 10% of gross sales, Yeti, authorized on Amazon Marketplace, represented 14% of gross sales. So I don't know how that doesn't count for 10% of gross sales. If you're selling through Amazon and 14% of sales. So I'm curious how Brian's going to score that on the concentration. Our market. Yes, we are in all of our major markets, and I'm sure they're multi-billion dollars in sales potential. So we design the products ourselves. We market them globally. We stipulate. Go ahead.
Do you mind scrolling up just a second? It said like some of the activities or the types. Okay,
the ambassadors.
The product design and development. That caught my eye. I saw rodeo cowboys, barbecue. So this is who they're trying to market to, right?
World-class anglers, hunters, rodeo cowboys, barbecue pitmasters, surfers, brewmasters, fitness experts, skateboarders, and outdoor adventurers who embody our brand, and industry professionals to test our prototypes and provide feedback that incorporate into the final product. Once we approve the final design, we partner with global suppliers and specialized manufacturers to produce our product according to our exacting performance and quality standards. So those must be the brand ambassadors they talked about. We collaborate with a team of ambassadors. Yeah. Okay. We distribute. Who do we compete with? We compete with Pelican, Otterbox, private label brands, Hydro Flask. Yeah, lots.
Have you guys ever heard of those?
Nope. Otterbox, I know. They made my iPhone case.
Okay,
that's a good brand. That's a good brand.
I've heard of Pelican. So another place I've seen a lot of like Yeti products is in the military, and a lot of these like military exercises I've gone on. They're so tough that a lot of people use them on for military stuff because they can take a beating.
That makes sense. If they're good enough for the military, that's a seal of approval. Okay. Well, the nice thing about this business is that it's pretty simple. There's nothing really complicated to understand. They make high quality products, and then they sell them. Let's just do a quick search for concentration. See if there's any other concentration risks. Concentration. Nothing. No other concentration risks. Okay, let's look at the most recent proxy statement. So let's go to ownership. Stock ownerships. Stock ownership. So what was their last names? These guys?
Siders.
Roy Siders owns 2%. Okay. Insiders own 3%. BlackRock, Vanguard, and Wellington own the remainder. So let's see. Roy owns 1.65 million shares. What's Yeti's?
$88.
Yeah, is that what it is?
I think so.
So okay, we'll call
it's
it
like 100 million.
Yeah. What's that? Yeah, about 130 million.
Okay.
And the whole business is worth $7 billion. So he wants the share price to go up, but he has no voting power or anything like that. These aren't Class B stocks. So less than 2%. Insiders own just 3%. Okay. What's up next? Glassdoor Yeti. Good place to work. Okay. Mission. Build the cooler you'd use every day if it existed.
I'd love to see if that's anywhere else.
Yeah.
Or did they just put that down for Glassdoor?
We believe that time spent outdoors matters more than ever, and our gear can make that time extraordinary. Okay. Yeti. He's not the... Okay, so there's a different CEO. Matt Rentuges. He gets good reviews, 4.3 stars, 93% approval rating, and 84% recommend to a friend. So let's go to the management team. Executive team. Okay. Matt. Yeah, let's click on him. So this is the CEO, Matthew Rentgist. Since September of 2015, okay, He was the VP of Outdoors at Vista Outdoors, a manufacturer of outdoor sports and recreation products. So he's experienced, but he has been there for about just over 5 years. Okay. What happened to where are the founders?
He must be on the board.
Yeah, let's check the board. Chairman is the co-president of Cortec Management. Okay, the CEO. For the CEO of Zynga is on there. The former president of e-commerce at Best Buy. I don't see the founders anywhere involved.
I wonder.
But he still owns.
He wouldn't have shown up on the thing if he wasn't listed where he was. He wouldn't have been there. So he must.
What was his name again?
Ciders. You know what? I'll look it up while you go on. I'll
Roy and something Ciders.
Yeah.
Roy
and Ryan
Cedars. I mean, this was what, 2006, so 15 years ago. Okay, so here's the CEO, Matt Rentges. He owns 700,000 shares, so that times 88, so that's $60 million of stock that he owns himself. So he wants it to go up. So okay. Let's check out how this stock has done since it's been public. Yeti. Pretty good. Up 400% so far and counting. That is some serious outperformance. Okay. How do they do versus Wall Street's expectations? Big beat, big beat, big beat, big beat. I like that. So for this year, they're expected to grow 23%, and that's expected to slow to 15% next year. Austin, do you ever look at analyst estimates?
I do. I try to come up with my own opinion first, and then when I'm trying to think about the current multiple, that's when, and like if that's sustainable or not, or if people are just way too excited about it and it's like excessive, that's when I might look at estimates just to see, hey, what are the expectations kind of built into this? I try to have my own opinion first, though.
Gotcha. It did say mission somewhere on here. We found a Yeti with a simple mission: build the coolers we'd use every day if it existed. Consistent.
To build the cooler we'd use every day if it existed. All right.
Okay. One that was built for the serious outdoor enthusiasts rather than for the mass discount retailer. So I buy that this is a mission-driven company, right? They were frustrated that they couldn't have the product that they wanted because they're outdoorsmen, so they built a company around it. I would like this to be slightly different, but I buy that they started this company because of a mission as opposed to let's make money.
I agree.
Okay. All right. Is there anything that you want to see, or are we good to go on this?
All I can tell you is that I looked up and it says that he is the founder and chairman at Yeti Coolers. So unless Yeti Coolers is different than Yeti, which I don't think it is.
No, does it have an end date on there? Because
there's no end date.
So two things. He was listed in the proxy, one, and he didn't have to be because he only had 2% of the stock. But why would he not be in the executive team?
That's very odd.
Yeah, that's strange. And he's not in the board either. Unless
it says he's the chairman.
He ain't the chairman. This guy is.
Right.
David.
I agree. That's just what LinkedIn says.
I wonder if they have press release about him stepping down or something. Did he step down recently?
That's what I was just looking for, is looking through their
board transitions. Okay, what's this? As of November 20th. So somebody else is coming on there. Blah, 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 blah. Board of directors resigned by somebody else that's taken over. Yeah. If you guys could find any information about that would be wonderful. But I think we're ready to start filling this in. Austin, so you want to clog your ears so I don't make up your score worse? Okay. So their balance sheet, it had $100 million in net cash, but it was not debt free, although they are paying down debt. So I will give them a 4 out of 5 on that. Gross margin was 58%, and it was rising. So that's a 1 point because it's rising and 1 point because it's over 50%. So 2 out of 3. Returns on capital. Will we get returns on capital data for Yeti? Let's see. Return on equity, return on assets, return on invested capital. Wowzer. 78% return on equity, 25% return on assets, 39% return on invested capital.
That's pretty good.
That is exceptional. Anything over 15%, I'm happy with. 3 out of 3 there. Free cash flow was growing. I'm pretty sure, right? Free cash flow.
Actually, it was, but I went back.
I count that as growing, but go ahead.
One thing I didn't like was that they presented the fiscal year results on the balance sheet and the free cash flow, even though it was the first quarter slide. Do you get what I'm saying? So I noticed that the free cash flow did fall from 350 to about 288 million. Not terrible. I don't know why they did that. That's just confusing.
Okay. Well, I'm giving them full credit for growing free cash flow.
Yeah.
And I'm giving them full credit for growing earnings because their earnings were growing. Okay. Moat. Do they have a network effect? No. Do they have a product ecosystem? They have lots of products, but they don't. It's not like you buy one product and it makes another product better or connects in some way. So no, they don't get any credit from product ecosystem. Do they have switching costs? No. When you're a consumer, there's no cost to you to switch to another brand or buy something from somebody else if you wanted to. Do they have scale economics? No. They're not they can't be the top dog in terms of manufacturing in this space. Distribution, physical location, or vertical integration. Nope, they contract that out. Their locations there's nothing there that gives them a big advantage. But they do have a brand.
Yeah.
And that to me is the moat here. And it is a brand that consumers are willing to pay more for. Right? They see the name Yeti and it convinces them I need to shell out more money for this brand because the product is superior. So I'm going to give them 10 out of 15 on that. You could even argue that it's a little bit higher than that, depending on how you value brands.
So Brian, I don't want to sway you either way, but I've had some time to do a quick Google search while you've been doing all this hard work. And there is an article, it's on some news site that says it compares a $39 Yeti tumbler to a $9 Walmart one. And essentially they come away saying that they both keep things cold the same amount of time. Mm-hmm. So what happens if the world finds out that, oh my gosh, Yeti coolers really don't keep things longer? Does that destroy the brand or not? I don't know. You decide in your score, Brian.
I will say that doesn't matter to me.
Austin, if I gave you a cup of the coffee from the farm I live on and I gave you a cup of coffee from Starbucks, would you stop going to Starbucks even though I can guarantee it won't be as good?
Yes, because I would then ask you to send me coffee from your farm every day.
All right, assuming that's not possible.
My response to that is, what's the difference between a Nike t-shirt and a Walmart brand t-shirt? Nothing. But I mean, absolutely nothing except for the check mark. And people will pay big money for that check mark. They are also clearly very interested in giving Yeti more money because they perceive the value to be there. So the brand is doing its job. So an article like that, if there was like a torrent of them and there was this massive online campaign, Yeti's terrible, then I would say this brand is damaged. But for right now, clearly they're taking market share. So I'm giving them credit for that. And I will also say that their moat is getting wider too. So I'm going to give them 15 out of 20 on the moat score. All right, potential. Optionality. Do they have the ability to launch new products or new services or enter new industries? Well, they're clearly launching new versions of their products, and I'm sure that now they have this brand, they can also continue to roll out other types of products. So I will give them that all are within their core mission of serving hunters, fishermen, rodeo people, all those other categories. So I will give them I'll give him a 4. I'll give him a 4 on that. Organic revenue growth. Well, that's clearly double digit. So that's a 4 out of 4 for me. Are they the top dog and first mover in an important emerging industry and or an industry disruptor? They are more of an industry disruptor because it's not like there haven't been these products beforehand. It's just that Yeti has come in and started to do them better with their own spin on things. So they're not necessarily a disruptor. They're more of a, hey, we have a better brand. But I'll give him a 2 out of 3 on that. Is there operating leverage ahead of this company? Let's look at their margins again. Gross profit margin. And then let's look at their operating margin. And then let's look at their profit margin. So Yeti keeps, for every dollar in sales, Yeti keeps 58 cents as gross profit. And then 20 becomes net operating profit, and 15 becomes total profit after paying all taxes. Is there room for that 15% to go higher? Let's compare that to Lululemon, which has much bigger scale right now. Lululemon got into like the 16% range, but I don't see that number going to 20%. Really anytime soon. So they're already doing such a good job that operating leverage is behind this company, which means that profits moving forward are going to be dependent on sales growth. So I'm going to give them a 2 there. All right, customer acquisition costs. Let's pull up their most recent quarterly report and see how much they spend on sales and marketing, or if they break that out. Where's revenue? Okay, so they just have a broad bucket. So they did 145 million in gross profit and 105 million on everything. So they don't break out sales and marketing. I would guess that half of that is sales and marketing. As a rough guess, that seems reasonable.
Yeah.
So that would mean 50 million on marketing to generate 145 million in gross profit. So that's about a third. So I think the Yeti brand is very word of mouth. Like I've never seen an advertising for it, but I know what it is. So I'll give them a 4 on there. Okay. Is this product recession-proof, cyclical, or a combination of the two? Well, let's look at revenue in a recession. Recession didn't seem to hurt them. But it's not like it was
a weird recession.
It was very weird recession.
It was the weirdest recession we've ever had.
Yeah, exactly. I'm not going to say that this stuff is like recession proof. I'll give them I'll give them
look at like
middle of the road grade there.
I was going to say, do you want to look at maybe not matter, but like I guess Lululemon you could look at as another like, premium brand that's been through a previous downturn.
Austin, that's a really good point because what we saw in the last in 2008 was how bifurcated it was.
Yep.
So, and what I mean by that is, for better or worse, probably worse, the people who buy Yeti are the least likely to be affected by a recession.
Yeah.
Yeah.
And so that's a good point.
Lulu, yeah.
I think that probably growth will slow and maybe slightly go negative, but it probably won't collapse unless there's some other factor going on. So it looks like Lululemon's total revenue dipped a little bit and then it just exploded. And in the Great Recession, their growth really didn't skip a beat. I mean, it slowed for sure, but yeah. So I'll give them a middle of the road grade there. You could argue that could be higher. All right, is their revenue recurring? Well, if you have a Yeti cooler, are you going to be buying a second, a third, a fourth, a fifth, a sixth, a seventh? No. They are kind of one time. I mean, that could, if you spend a lot of money on a Yeti cooler, are you going to buy another Yeti cooler? I would say the odds are okay of that happening, but do you really need multiple ones? No. So I'm going to say 2. I'm going to give them a 2 out of 5 there. Can they raise prices? They have a brand. So I'm going to say yes. If they raise prices, I'll give them a 4. The founder is their soul in the game. Did anyone know the founder question?
I went through the proxy statement and it just says that the stuff that he owns is owned by a trust, but I haven't found evidence of him being on the board anywhere.
Okay. So I'm going to say he's no longer involved because you would be on the website, right? He's on the website, the founding page, like our founding story, but he's not on the management team. Like that seems weird. So I'm going to say that the CEO that's there now, I'm considering the manager, and he's been there for 5 years. So I'm going to give that a 2 out of 4, and that might be even generous. Inside ownership. Well, insiders own less than 1% of shares, but the CEO does have $60 million on the line. I'll give that a 1. Glassdoor rating, those were good. The mission statement, I will give full credit for. I'll give full credit for that. The stock price has spanked the market 4 out of 4. They're paying down debt. I will give them even pretty considerable. So I'll give them a 2 out of 3 on that. And they beat all 4 of their expectations. That's a 75 before we get to the gauntlet. All right. Accounting irregularities, nope. Customer concentration. Amazon is 14% of their sales. Amazon is pretty notorious for saying, hey, you're doing good. We're going to do that too. So I'm going to knock off 3 points for that. Industry disruption, nope. Commodity prices, outside forces, nope. Big market loser, nope. Binary event, nope. Extreme dilution, we didn't check that. What is the share count? Shares outstanding. 1 year on a percentage basis. 1% dilution. That is perfectly acceptable. Growth by acquisition, nope. Complicated financials, nope. In fact, they're pretty easy. Antitrust concerns, nope. Headquarter risk, nope. Currency risk, nope. That gives us a broad category of 72. And for me, that is in my investable range. So I'm going to say, while this is no, this is yes, this is yes, and this is yes, I'm going to give it a 72. All right, let's do the anti-fragile score. Brian?
All right. To start off with the mission, I'll go ahead and give them full credit. I don't think this is the best mission statement ever, but I can see how it was used as a guiding principle. So for the moat, like we said, brand is the only thing I see, and I max out the amount that I give brand at 1, which has led to me here. Let me just say real quick, doing that, giving less points for brand has led to me and missing some great investments like Lululemon. That's a great example. It has also led to me avoiding a ton of terrible investments. So I'm comfortable with sticking it at just 1, even though I recognize it is a very strong brand. Optionality, I go to 2. I'm impressed they've got bags. Like, that's crazy to me.
If you make bags, you impress Brian.
Yeah, if you make bags, you're a winner in my book. They've got right now 190 million in cash, 105 million in debt. They're paying that debt down fast, and they've got a lot of free cash flow. So I give them +1. I think that whatever competition they have that's meaningful, they could undercut. I'm not going to take offer concentration. Let me just real quick explain why. Because this is so powerfully brand recognized, I would be worried about Amazon going after me if I made something that I was able to sell for really cheap. I am not worried about Amazon going after me if I am getting it because of my brand, because I think that's really hard to do. Glassdoor, full point. Founder will leave it 0 since he's mysteriously not there.
Since he's there, but he's not there, but he's there.
And ownership, I put it -1 because, I mean, if you throw him out, the insiders only own like 1% of the company. And it's not like this is a 70 or $700 billion company. This is a $7 billion company. So 6.
6. So that is in your fragile. So this would be in your skip category. So
with full recognition that this, I think this is a high quality company for what it does, but it just falls outside of what I'm interested in.
Austin, I'm curious to see how your score is different than mine.
Yeah. So one quick thing, I was just looking at the transcript of their May 13th earnings call, and I just searched founder, and it says, before I turn the call to Paul, you may have seen Roy Cedars, founder of Yeti, has elected to step down from our board of directors. Roy will continue to bring his passion and creativity. So I guess that happened. That was Q1 2021, May 13th. So
they didn't issue a press release?
Yeah, that's weird. I don't know.
That is weird.
Yeah.
That's very odd.
That's super odd. I mean, he must have not been on the management team, just on the board. No, they still have to announce board things. The founder is stepping down and they didn't issue a press release.
And there's nothing in the news about it. Like an Austin newspaper didn't pick that up.
Yeah.
All right. Maybe something's going on health-wise.
Yeah, I could see that.
He wants to keep that to himself. So, okay.
And they're kind of a small brand, right? Anyways, back to the great reveal, right? So what do you two think I was higher or lower than Brian's score?
I'm going to say you're higher.
I ended a pre-gauntlet score of 60 and
wow.
A -6 in the gauntlet. So the final score for me is 54.
Oh,
so
right.
Like, wow. Just for all the viewers, like, look at that huge difference, right? And that's the awesome thing about, investing in these checklists is we're all different. Do you want to try to figure out where we were different, Brian, or do we not want to go?
Yeah. Did you give them less points? I mean, the biggest points for this company on mine was on the moat. I gave them 15 out of 20. Is that,
okay.
do you devalue brand?
I did. I did give them 3 points for network effect, because I think if it's not exactly the right way to use the term, but if you buy one of their products, you will likely buy another or something. Cause I think a lot of them kind of like go together, like they fit together in crazy ways. But if the other thing is it's all made to last really long. So it's not like you're going to replace stuff. I did not give them anything for switching costs, nothing for a durable cost advantage, because I think you gave them points for cost advantage.
I did not.
No. Okay. Anyways, I gave them, let's see, 11 points for moat and then 3 points for the moat direction of widening. Optionality, they only walked from the potential category. They only walked away with 4 points for me.
Okay. That's what I gave him too. I gave him 5 for moat direction because stable to me is 3 points. Widening is 5.
Do you want me to share my screen? I'm curious, where were we so different?
Just go through. Yeah, I'm curious to see this too.
I think I've just stopped mine.
Can you see?
Yep.
There we go.
All right. So
can you zoom in a little?
Sure. Nope. Going the wrong way here.
Upper right-hand corner where it says update. Keep going. All the way in the upper right-hand corner. All upper right-hand corner, all the way up and right, where it says update. Click update. Hey, and then do the zoom.
Oh my gosh!
I just learned something here. I had no idea that's where you're supposed to go.
I was like, "There's no way. There's no way
idea
that works." All right, now I got to scroll back over. You can see I've been using this checklist.
All right, I see that.
That's a great advertisement there,
right.
Austin.
I love this checklist. I bought it too. Everybody go out and either get it for free or buy it at Brian's link. It's awesome. I love it. Okay. So anyways, 54. I think I was a little bit lower on gross margin, maybe.
Yep.
I think their gross margin is actually going to have to come down over time, especially if they want to expand past a certain growth amount, because they're going to have to get into some of those bigger retailers where they're not going to have as much bargaining power. Plus,
fair enough.
I think DTC is going to come down a little bit as we get out of the pandemic and they go back more to more retail stores. So that might be why that was down a little bit. Moat, I think we were pretty much the same in there.
Close. Yep. So you only gave him a 2 for optionality out of 7.
Yeah. And I think, let's see, because my worry is if they try to go, why is this not scrolling? If they try to go and come out with too many different products, then they're going to lose focus and potentially lose some of like the premium brand stuff, or maybe go too wide and end up being a negative, like they're too spread out as a company. I think that's why I did that. Like I don't know. To me, that's not a super exciting industry. So 0 points. Operating leverage ahead. I think that the business it's weird. Like usually young brands are less efficient when they're younger, and as they grow, they scale to be more efficient. But because they have such a premium price tag and they started off that way in all these smaller retailers, I think they're going to get less efficient with scale.
Yeah. That's possible.
That makes total sense.
Yep.
Yeah. So that's why I went that way.
That would be that would be leverage in the wrong direction.
Yeah. No recurring revenue. They do have pricing power now, which I gave them a 4, but I think that's going to come. They're going to have to compete on price eventually if they want to grow beyond a certain point. It's weird. Once you zoom in, I guess you can't go down with your no soul in the game.
Inside
a 1
ownership
on inside ownership, Glassdoor ratings. I gave him a 2 on mission statement, and then the rest. Yeah, so I don't know, where were the big differences.
Well, a couple. I was just more generous with mine. I gave him more points for the moat. I gave him a 2 out of 4 on the management. I gave them just slightly higher points here and there. I think I gave them some points for top dog and first mover. I gave him. I might have overestimated the operating leverage ahead. I gave him 2 points. You gave him 0. I agree with you, kind of. They might be a 1 there. But hey. The as we've said multiple times on this show, the value is not in the score. The value is in the process.
Yep.
So for me, I'm not going to rush out and buy this stock, or I'm not like foaming at the mouth to add it to my portfolio. But if somebody else owned it, I would say, I understand. Like, I understand why you own it.
And one thing I'm just going to throw in there, valuation is not a part of my framework whatsoever. But that's because I don't invest in companies that aren't anti-fragile according to the score that I get. But when a company isn't, when it is fragile, then I do get curious about the valuation. So if I'm doing like back of the envelope, then they're trading at about what, like 22 times free cash flow? Which
what was their free cash flow? 300 million?
In that range, yes.
Yeah, about there, and about 44 times trailing earnings, 40 times forward earnings. So they're priced for growth, but they're not priced for.
Yeah, what I was going to say
growth.
is that's not terrible given their trajectory.
Mm-hmm.
I assumed it would be much more expensive. So there you go. Like I've talked so much on Twitter recently about how I don't pay attention to valuation, but if it's not anti-fragile, well, then I do care about it. And I'll be honest, I'm not going to buy it, but that's not a terrible price at all.
Yeah. Austin, final thoughts on Yeti?
Yeah, I think it could be totally wrong on this, but retail can be a hard industry, and they've got the premium brand thing going for them now. My big concern is just how big can they grow and keep that premium image without having to scale into those larger retailers where they're going to lose some of that image and some of their efficiency and their margins. So it's a no. It's a no for me, Simon.
Yeah.
That was from
a joke.
America's
Good one.
Got Talent.
I haven't watched American Idol in forever.
This stock has been a winner. I like that. I like the brand name. And again, if you're passionate about the Yeti brand, could this company be a market beater? Sure could. It definitely could. I don't think the valuation today, and we're recording this on Monday, June 21st, is all that extreme. But yeah, this isn't a business model that I particularly like. I would be far more interested in this company if it was a $1 billion business with these numbers than a $7 billion business. Like I would want, if I was going to invest in a company like this, I would want at least 5x returns. And that is just much easier when you're a $1 billion company than a $7 billion company. Although Lululemon is approaching 50 billion just for, right? Are they the Lululemon of their categories? I mean,
they could
maybe.
They could open up their own stores.
This could continue to multi-bag even from here. I don't have a clear path of understanding that, but
I don't either.
Yeah. Anyway. All right. Well, thank everyone for watching. We super appreciate it. If you want to suggest stocks that we should take through this framework, please do so in the comment below. Of course, like and subscribe to this video. It helps us get the words out. Thanks to Austin for guest hosting today. It was a lot of fun, Austin, and it was really eye-opening to see just how different our scores were on a company that was pretty easy to understand.
But it's a great lesson.
Totally is.
Yeah. Thanks so much, guys. This was fun, and love what you're doing out there for so many people to help them. So thanks a lot.
Thank you. All right, Brian. I will see you next week.
All right.
Bye, everyone.